earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cashflow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cashflow.
So good afternoon and welcome to the School of Cashflow podcast. I'm the host, Dale Corpus. So real estate investing is a long-term play. It's not a get-rich-quick scheme. So if you're trying to get rich fast with real estate investing, it might not be the right vehicle for you. So patience in this business is key. Time is on your side. It's your friend in real estate investing, as the compounding effects of the growth of your real estate investment portfolio is what will eventually snowball into massive growth. And as you know, for me, when it comes to real estate investing, I personally like investing in passive real estate syndications. I don't necessarily have all the time, to be an active investor managing the day-to-day of investing, as I'm a productive realtor running my real estate sales business and managing my sales team. I know many of you listening have your businesses or your W-2 tech jobs, and you're busy doing that. But the cool thing with passive real estate investing is that you could truly do it on the side without a lot of heavy lifting. And I love that I could continue selling, real estate, as I really have a passion for it. And I love continuing to be able to grow my real estate investment portfolio through syndications. And you really don't need to give up your day job if you don't want to get involved in real estate investing. So my guest today is no stranger to the world of passive cash flow investing. He's been doing it since the early 2000s, and I'm really excited to have him on this episode today. His name is Jeremy Ruhl, and here's a little bit more info about him. So Jeremy started investing in real estate and businesses in 2002 and left the corporate world in 2007 to become a full-time cash flow investor. And he's currently an investor in more than 60 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Ruhl Investment Group, Jeremy manages a group of over 1,500 investors who seek passive managed cash flow investments in real estate and businesses. And Jeremy's also the co-founder of For Investors, Buy Investors, also known as Phoebe, a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning among real estate investors in a strict no sales pitch environment. Phoebe is now the largest group of public real estate investor meetings in California with over 30,000 members. So let's just jump right into this. Welcome to the show, Jeremy. How are you?
Good. Thanks for having me. I really appreciate it. And by the way, I don't know if I've even told you, I actually am also a licensed California. I have a broker's license, but I've never used it for anything but investing. I've never done anything retail. So
very, very cool. So, hey, for my audience that doesn't know you yet, where are you based out of geographically?
Yeah, I live in Los Angeles. I'm just literally a few blocks south of Beverly Hills.
Tell me a little bit more about yourself, perhaps that the bio doesn't cover. I mean, how did you get into real estate? What were you doing even in your corporate job prior to real estate?
Yeah, sure. So I come from the corporate world, although it's been a while since I've been in it. So I kind of went down a typical corporate path. I had over 10 years of business experience. My last two jobs, to give you an idea, I was at Toyota headquarters in Los Angeles in 06, 07. I was at Disney headquarters prior to that between 02 and 06. And I was mostly in marketing, a little bit in finance. I have an MBA from the Wharton School, which is like University of Pennsylvania. And I'm from Montreal. And I've spent about half my life growing up and living in Montreal, and then half my life here in the US, most of it in LA. I started investing in real estate and passive cash flow opportunities in 2002 as a result of the dot-com crash. And reason being is that after the dot-com crash, I'm just a really low risk, kind of slow and steady, more predictability type guy. And so when I saw all the volatility and just the lack of predictability of the stock market after the dot-com crash, I said, this is not a good strategy for my long-term retirement. And to your point, this is a long-term game that's very important. And so without having that predictability, I was like, I got to find a different way to do this. I don't know what my retirement is going to look like in 20, 30, 40 years. And so I kind of concluded that focusing on more lower risk passive cash flow opportunities were a better fit for me because of that predictability aspect. And I rotated all my money from stocks and bonds into cash flow between 02 and 07. And then I got out of the corporate world in 07, actually had a last strong moment in the corporate world and left the corporate world. I wasn't planning to in 07, but I had the cash flow built up. So I've been a full-time passive cash flow investor for about 15 years, but been doing passive cash flow investing for about 20.
Okay. Curious, how did you first learn about these alternative investments and syndications and whatnot? I personally didn't know about them until 2010, but you were already kind of connected to this in the early 2000s.
Yeah, so it was really interesting because when I started looking at different ways to invest, I approached a lifelong friend of mine from Montreal whose family, including him, had been investing in real estate for 20, 30 years at that point and had a lot of experience. And I started to learn about what they were doing. And funny enough, they were actually syndicating, meaning they were actually taking on groups of investors the way that I invest now. So I was really lucky because I got to learn from them. I did my first few deals with them, but I was able to go on site on the deals, get much more detail than a normal investor would get, understand things better. And then eventually what I did was, once I started to like what I saw and thought it was a good fit for me personally, I started to go to a lot of local meetings in LA. And there's a lot of meetings around town in a big city like LA that are real estate based. Some of them are sales pitches, some of them aren't, which is why we started For Investors by Investors, because of all the sales pitches. I was trying to avoid going to those. But regardless of sales pitch or not, there's always good networking, and there's like hundreds of people that go to some of these. And it was very popular between 2002 and 2007 when I was doing that. The landscape has changed now, and now you can listen to podcasts, you can go to conferences, you can do stuff virtually. So it's different, but that's back then. And so I grew the network and my understanding by attending a lot of in-person meetings, learning about different asset classes, networking with other people. And networking is the key to finding opportunities in this space for the most part. Some of them are allowed to be publicly marketed, and most of them still are not. And so networking is absolutely key to really expand your horizon in this type of investing.
Was it always your goal to leave your corporate job when you started investing in 2002? I mean, I know you left your corporate job in 2007, but was that even on the top of your mind?
No, that's the thing. I talk to a lot of people now who say to me, I want to get out of the corporate world in 5 years or 10 years. How do I do it? And we kind of go through it. I'm not a financial advisor or anything like that. I'm just an investor.
Yeah.
But I kind of take them through the steps of the way I see the path. But so I actually just wanted to have the paycheck and the more predictable cash flow on the retirement account side, and intended to just do the corporate job for a long time. But I had a last strong moment with my manager at Toyota in the corporate world. And because I had enough cash flow coverage built up to live off of, I decided to take a risk, leave the corporate world, but it was completely non-planned. But I did it only because I had about 2x coverage of cost of living versus cash flow. So I decided to take that risk, and I'm a very low risk guy. So I was very comfortable with the risk given the cash flow coverage at that time, but it was definitely not planned.
Okay, I got you. So I know you invest in both, cash flow, real estate opportunities and business opportunities. I know most of my folks that are listening are interested in real estate, but on the business side, because I'm curious, what kind of business opportunities have you invested in, or you like investing in?
Yeah, so I would say that the underlying theme for me is I like to invest in cash flow, more predictable, low risk cash flow, and preferably asset-based, predictable, low-risk cash flow. And so real estate's a great asset-based type of investment, typically, depending on what it is. And so that's one of my favorites. But sometimes I will make business investments where the assets aren't necessarily as obvious, and so the cash flow has got to be higher to compensate for the risk, or at least the payback period has to be quicker. So there has to be something to compensate for the lack of the asset basis in that risk. So one really easy example for me, I've been investing in ATMs since 2008. And have a lot of good success. It's been about 14 years in January that I've been investing in them. And, that's just basically you're getting a certain profit split of a surcharge whenever someone goes to use a little third-party ATM at Joe's liquor store. We're that machine for $3 or $4 with a surcharge, maybe $2.50 or $2 in New York. And I'll get a portion of that profit. And the profitability will be very high. The payback period is a different equation in real estate, right? And so I'm a huge fan of diversification, even in what the specific asset, let alone across assets and everything. And so I've diversified into other assets. Sorry about the doorbell. Diversified into other assets over the years, and some of them in business assets as well. I can give you other examples too, but that's the easiest one that comes to mind.
Okay, got it. And I mean, what does it mean to be a full-time passive cash flow investor? Does it mean that you're just sitting around just collecting, checks and all that in ACH deposits, or are you actually actively doing other stuff?
Yeah. So, I guess it depends on your personality, but I'm a very type A personality, and I actually work more than I did when I was in the corporate world. And so part of the reason is because after a certain amount of time, what happens is that if you're going into, let's say, a 5-year deal or a 10-year deal, when you're 5 or 10 years into it and you've deployed hopefully all your capital, now things are actually exiting and you're having to find new things. And so because I took the strategy of being hyper diversified, which I frankly don't recommend for anybody, I'm in over 60 different LLCs right now, and it's a lot, but I actually really love diversification. So that makes it even more challenging for someone like me, because I always have things coming up. I mean, I can give you examples. I mean, I have one thing cashing out in a week, a self-storage facility. I had several hard money loans that just cashed out in the last week or two. I've had quarterly payments come from a ton of stuff, because it was, most of the stuff I get is quarterly, and I have to redeploy that capital. So I'm constantly, the worst thing that I could do as an investor is have my money sit in cash. And I think now we all understand really well that you're at risk of inflation, even in normal times, let alone what's happening today, of actually having your money value degrade over time. So I'm constantly under pressure to find stuff to reinvest in, to keep the cash flow stream going, so I don't have to go back to the corporate world, to snowball it and grow it bigger, to compound it, and to not have it sit in an account and kind of be at the risk of, disinflation, so to speak, in terms of what it's worth. So I work really hard, and it's honestly not easy, because, there's, even though all the work I do is upfront. So, I don't do any work on an opportunity once I invest in it, right? That's where the operator takes over once they close on the property. And then I'm just reviewing the quarterly reports and making sure I'm getting the checks and everything looks okay. But all my work is upfront, and finding the opportunities. If you're really picky like me and you really try to weed through a ton of stuff, finding the opportunity is really the number one thing I focus on all day long. And it's hard. You have to build a big network. It takes a lot of time. And because most of the opportunities are not allowed to be publicly marketed per the SEC, you have to do a ton of networking to find them.
Okay, so I just really find it very interesting that you say that you're busier now than when you're working your corporate job. I mean, what if I were to dissect your day? I mean, what do you do from a day to day? Like, how do you stay productive, or where's your time spent? I just I think people would want to know.
Yeah, sure. So my day is very structured and scheduled in a very specific way. First, the thing to know about me is that in order to avoid a lot of the pitfalls of the landmines that might come up, I have to constantly think ahead, because I go into a lot of 10-year deals. So you can imagine I am actually under the pressure of having to figure out where technology is going to be, what trends are going to happen in 5 to 10 years. So if I invest in an asset today, I don't have to worry. I hopefully will minimize the risk that it actually won't be out of favor in 10 years and might be worth less. Great example is online and retail, right? If you invested in a Best Buy or whatever, take your pick, Circuit City, right, retail strip center in 2013, and you have to sell it in 2023, you've got a big problem, right? You have to fill it in. They probably left, you probably didn't have cash flow. So I actually read about 2 to 3 hours of news a day, trying to sort out what's going on in the economy, what's really going on, not just what the media is telling us, where the trends are going and everything else. So that's one thing that I do. And I do a lot of that when I first wake up, and I do a lot of it also late at night. And I do it frankly throughout the day in bits and pieces, but most of it's the beginning and the end of the night. I usually schedule my first calls for either 11 or 12, so give myself enough time to do a lot of reading and reply to some emails in the morning. And then I'm on scheduled calls typically between 11 and upwards of 2, 3, or 4 o'clock, like straight every day. And those are all networking calls. That's literally all it is. It could be me talking to another investor to network or exchange ideas. It could be me talking to another investor group to see what's going on with them and exchange ideas or talk about deals. It could be me talking to a sponsor and discussing a specific deal. But in order to have the type of network that I need to have to find enough opportunities, I'm just constantly networking all day long. And then once those scheduled calls are done, I work from 4 to 6 on emails and follow-ups. And by the way, some of that could be even reviewing opportunities at that time of day, because that's my first window to do it, right? To actually look at these large documents. And then I'm with my kids from 6 to 7:30, and then from 7:30 to typically 10 o'clock, I'm continuing to do work, whether it's looking at opportunities, reply to emails, preparing for the next day, whatever it is. So that's like, it's the same thing every day for me.
Okay. Wow. It does sound like a lot. It's your day is action packed.
Yes.
How many days, like, I know one of the things that just jumped out at me, you're looking at a lot of deals right now. I mean, can I ask you how many deals that you're typically juggling and looking at, even on a weekly, daily basis?
Yeah. So, we're recording this in 2021, and it's a very interesting time because of the ongoing pandemic and other factors and inflation. So what's happened is that the deal flow is, I would say, slower than, let's say, 2019 pre-pandemic. But there's still a lot of it going on. And one thing that I have done is I've actually been kind of psychologically on the sideline since the end of 2016 because of high asset prices. And so I pushed my sponsors as much as I could to sell between 17 and 21. And I'm waiting to see if there's going to be some type of asset price or market adjustment. So I'm not really open-minded to a lot of traditional opportunities right now. A lot of the pricing and the cap rates are just not the right fit for me. So I just want to say that because I basically can weed through a deal very quickly these days, right? Compared to a normal time in the cycle. I couldn't tell you how many deals I'm seeing in a given week because I've never even thought about it, honestly. But because every day is different. Like, and it could even be me like hearing about a deal on the phone. I heard one yesterday on the phone, but then I said, okay, that's not for me. I'm not going to look at the docs, right? But then I could have got another one, I got another one through the email the day before I'm thinking of that I am looking at. I mean, there's so much stuff going on for me. And it's partially because I have all these balls up in the air with the amount of opportunities I'm in. So I've created a bit of a monster for myself, honestly, but I love the diversification. Yep. So
going back to like when you first got started in this space, what was your first real estate investment? Was it a syndication?
Yes, it was a syndication back in 2002. It's funny. It was either office, retail, or industrial because that sponsor I mentioned that I started testing with did those three. But I can't remember this is not the first time I've been asked that question. I got to ask them. I was actually on the phone with him earlier today. But it was one of those three, which is funny now because I'm not looking at any of those asset classes right now. And but it was definitely one of those three. It was not like apartments or anything like that, which a lot of people tend to get started with.
Yeah, I guess most people seem to start up with multifamily, and I'm actually was assuming that you were going to be saying multifamily as well, but it was something different.
But I'll tell you though that multifamily has become, I would say, the number one asset class. Probably 80 to 90% of deals I see now are multifamily in the last 2 years during the pandemic, and that's for a lot of different reasons. But I would say that it was a more diversified pool of opportunities back between, let's say, in this cycle between 09 and all the way up to 17 or 18. So this whole multifamily trend has been like very concentrated very recently.
I've been noticing that myself too. I mean, speaking of multifamily, what are your thoughts on multifamily even right now or even in the next 5 to 10 year horizon?
Yeah, great question. So one of my 4 favorite asset classes for the next 10 years when you're thinking further out that I was mentioning before is definitely multifamily in the right locations because everyone's always got to have a place to live. And if you're choosing the right location with the right demographics, the right job growth and everything else, you're probably going to be okay. Putting weather aside and other potential factors. The challenge for me right now, though, is the current pricing of multifamily, right? And that's just not a multifamily thing for me. It's an everything asset class for me, right? And which is why I'm mostly on the sidelines. You and I invested in a deal earlier this year that was actually very unique multifamily. So I'm open to very unique situations right now because you always have to be, and sometimes they're out there, where we invested in a tax abatement structure multifamily that gave us about 150 basis points padding at closing compared to what it was purchased at. And now all of a sudden we have this padding in case the prices adjust, and that makes sense to me. But generally, multifamily is very tough for me for 2 reasons why now. One is the pricing, and 2 is because a lot of the deals are doing 3+1+1 loans, which are bridge loan styles, in order to do a heavy value add type of push on the property. And I don't generally invest in heavy value add to begin with, just from a profile perspective. Nothing wrong with it, just not what I do. But I also, even more so, don't do it at the end of the cycle. I'll consider it at the beginning of a cycle. And in my opinion, we're at or near the end of a cycle. So just the wrong timing for me for that too.
Okay, got it. Do you do any active real estate investing at all, or is everything passive?
Everything's passive that I've ever done, ever. Nothing's active. I mean, the closest I am to active is I do hard money lending, but I do it through a broker, and I am on first position loan on the title of that property when I do it. But I don't manage any, meaning that I just signed a document and someone else is managing they just take my money, they do the whole thing. So everything I do is passive. I just started that way in 2002 because I was so busy at my job at Disney. I just didn't have time to be active. And what I've learned over time is that it's just the right personality fit for me, which is, I think, a big piece of that active versus passive comes down to personality for sure.
For folks just starting off in this space, potentially, I mean, is it like necessary for them to have a lot of money already? I mean, can they even get involved in, syndication investing if they don't have much money?
Yeah, great question. So yeah, I think you have to kind of bifurcate this between accredited and non-accredited investors, right? So you don't have to, like, a lot of people think, oh, are you accredited? Oh, it's like part of a club where you have to join something. No, accredited is just a definition by the SEC of whether you have a certain income or net worth requirement. So just to clarify it, and again, I'm just telling you what I remember. I'm not like an investment advisor or anything, but I think if you're single and you file your taxes single, you have to make at least $200,000 for the last 2 years and expect to make $200,000 this coming year. Or if you're married and filing joint, you have to have made at least $300,000 for the last 2 years and expect to make $300,000 joint in the next year. Or you have to have $1 million net worth or more, excluding the value of your primary residence. So if you're accredited, you have a lot more access to opportunities. If you're not accredited and you don't meet those requirements, it is much harder to invest, especially now at the end of a cycle, because there's so much money chasing deals that the sponsors don't really need to take accredited investors at the moment, right? Because they're going to have a lot of demand from the, they don't take non-accredited investors. So they're going to have a lot of demand from the accredited investors. So if you have very little money to invest, even if you're accredited, some of the better ways to invest, which are more recent things that have come up, are crowdfunding. And the full disclaimer is that I'm actually an advisor for Realty Mogul, one of the larger crowdfunding websites. I haven't done much for them in the last few years, but I've been with them since before they launched in 2012. But I'm mentioning this not for Realty Mogul because I'm not speaking on behalf of them right now, but in general, you can go on to the Realty Moguls of the world, a lot of different crowdfunding platforms, and invest as little as 500 or 5,000 to start, even in some real estate deals or funds, even if you're not accredited. So if you're not accredited, that is the number one way I always suggest people, or that's the number one route that I suggest people to look at, because there aren't that many alternatives. If you are accredited and have more money, then you should expect the minimum investments for a typical accredited investor deal to be realistically these days about 50,000. That could revert to 25,000 if and when we have a downturn and it's harder to raise funds for the sponsors. But at the moment, you have to expect to invest at least 50,000 into a deal. And because you're taking on additional risk when you're passive because you're giving control to somebody, I would strongly recommend, if you're going to be going into these deals, that you have multiple $50,000 chunks diversify across multiple asset classes, geographies, and operators, right? So I wouldn't tell you to take your 150,000 chunk and just put it into one deal. Maybe then you want to take a look at crowdfunding and spread it across a bunch of sites, or maybe just wait. So anyway, I'm one person's opinion, but I just like to be really diversified.
Yep. Going back to just when you started, nowadays we're spoiled in the fact that podcasts such as this are available for people to learn. I mean, but when you started back in 2002, like, how did you even learn about all of this stuff and feel comfortable? I mean, what were you doing? Were there mentorships? Did you have mentors yourself? I want to know how that worked.
Yeah, sure. So I did not have mentors, probably should have, but I didn't. The way that I learned, which was honestly a lot of work, is two ways. One is I went to a ton of in-person meetings, so I was able to leverage the fact that I was in LA and there were a ton of meetings. I'd go to an average of 2 to 3 meetings a week. Okay. And then in 2007, when I co-founded For Investors by Investors, we had our own meetings. And so I'd go to other meetings and I'd actually manage my own meetings for additional networking and just sharing and learning with people, which was great. And I did a ton of that between 2002 and 2000, very aggressively between 02 and 11, probably about 02 to 11. And when I had my second child late in 2010, that's where it started to get more difficult for me to really do that on a very regular basis. And one way that I learned a lot was not just listening and going to listen to panel discussions about a certain asset class or various asset classes. I learned a ton going in person and listening to what the sponsors were doing and how they worked, and all different types of topics over time. But I also learned a lot from what I call opportunity exposure. So it's one thing to learn, okay, how does self-storage work if I don't even know how it works, right? You can go learn that through watching, panels or speakers or whatnot. But then how do you know if you're getting a fair or not fair investor return split and fees and management fees and all this, right? So that I learned through what I call opportunity exposure, which is actually much easier to do today, which is, today with the crowdfunding sites, you can log on and download like 20 multifamily deals and actually put them all next to each other on a table and compare them all. And you can say, oh, this deal is giving me a 6% preferred return. This one's giving me a 10% preferred return. Why is this one so much better? Are there more fees? What's the difference? And you can compare them all, right? Which is a fantastic thing. So I did a ton of opportunity exposure and comparison for myself to learn the different splits and everything else that I should be looking out for over time. So just more a question of, in the end, it's just basically experience, but it's really going out there and proactively trying to learn that way. That's how I learn.
Okay, got it. What opportunities right now are you seeing in the passive real estate investing space? Perhaps with, asset classes or, or just, anything that you want to chat about.
So you're speaking specifically real estate, correct?
Correct.
Yeah. So real estate's really tough, at least for me. I think that I'm the kind of guy that is not comfortable with, let's say, going into a multifamily deal today on the premise that it might get reduced value. Let's say it could go down in price if we have an adjustment in the next 1 or 2 years. But if you're in a 10-year loan, you'll eventually make that back up, which is probably actually accurate. It probably will end up fine in 10-year period. But I just don't like watching it go down and having got in at the wrong time. And so I'd rather wait it out. Some people are not like that, and everyone's personality is different. So for me, real estate's really tough. I've been doing, as you and I have done together, some very hard to find, but tax abatement apartment deals, low-income housing tax credit apartment deals. Both of those are purely for mitigation of downside risk if asset classes change. It's not because they're giving me these crazy outsized returns, although they do have good returns. It's more for me about the downside risk mitigation of what might be coming up. On mobile home parks, which is one of my 4 favorite asset classes for the next 10 years, those cap rates are just crazy tough. And I've been investing in mobile home parks, I think, since 2009 or 10. And I've just watched the cap rates go from 10 to 13 to like the current 5 or 4.5, which is just crazy to me. So I'm on the sidelines with that specifically. I haven't really found much that's unique in that asset class, unless you're willing to take much more risk, which I'm not. But I am planning on definitely going back into those big time if and when we have an adjustment. I'm just going to wait and see what happens. Self-storage, again, cap rates are too low for me, but I love that asset class in the long term. And actually just exited my last self-storage investment. No, that's not true. I'm in a couple others, but I just exited one that I was very happy because we got a crazy low cap rate, and I'm just waiting to see if stuff will adjust. But I love that in the right location for the next 10 years. And then senior living, love the upcoming demographic, of that generation. Tells us there's going to be a huge pickup in demand as of about 2023, just statistically. So I've been looking at asset class for years. It's very challenging for someone like me to invest in it because the vast majority of deals, because there's so much future demand, is all development, right? Which we need. We need the extra units. But I've never invested in a development deal. I invest for cash flow. So finding a stabilizer, minor value add senior living facility is very difficult, and I continue to look. And also senior living at this very moment with the pandemic continuing is also having its challenges for sure. I'm in several deals, and some of them have done better than others with COVID. And so none of them are disaster, but some of them are having to pivot. It's been very tough. And then, industrial is very much in favor right now. It's tough for someone like me because I like tenant diversification. So if you're looking at a single tenant building or just a 2 or 3 tenant building, it's very tough for me to do because there's enough tenant diversification. But that appears to be a very strong and good long-term play if you're okay with the current cap rates. Hotels, not for me because the average daily rate changes every day, so the predictability isn't there. Although there's definitely an argument to be made that if you find a reduced hotel deal right now, it's a very interesting timing, with the likelihood of travel picking up over time. And then retail and office, the predictability of those asset classes is still very uncertain. So that's really tough for me right now. Things have been trending online. The pandemic accelerated. It's very unclear if we have a surplus of retail inventory going forward or not. And same thing with office, with working from home. So that stuff hasn't actually sorted itself out yet. For someone like me with the uncertainty, I just tend to wait. I have a number of office and retail and industrial investments from years ago that I still have today, but I'm not looking at any of those right now. And all of those, frankly, every single one to me is overpriced at the moment. And that's the problem across the board. And so that's my quick run through of real estate. I've actually done on more real estate though. I did 2.5 times more hard money lending, which is lending first position loans to single family flippers in 2021, because the supply and demand imbalance was hugely in favor of investors where there was very little supply of housing and the prices went up a lot. So I just did a ton of that. And I'm trying to assess whether I'm going to continue to do a lot of that in 2023 or just toward 22 or like a normal amount. I'm trying to figure out where we really are in supply and demand going forward, because interest rates are likely going to go up next year. So it's a tough equation for that too. So real estate's really tough for me right now, and I'm just kind of waiting it out.
Then on the flip side, then if I were to ask you the same question on cash flow types of investments that were non-real estate related, more so on the business side, I mean, other than the ATM funds, ATM types of funds and whatnot, what else? I mean, is there anything else you see opportunity in?
Yeah. So one of the things I have been doing is trying to figure out what the hell to do while I'm waiting, right? And so there's been 3 buckets I focused on. A couple of those we touched upon today, but I'll just make it a little more clear. One is short-term stuff where I think that the risk reward is good, like hard money lending, really good example, right? For the past year. 2 is opportunities that are unique, where I think the pricing is so unique or there's some downside risk mitigation that I'm comfortable moving forward. The tax abatement multifamily deals is a great example of that. And 3 is opportunities where I don't have to worry about asset prices decreasing, even if we have a downturn or an adjustment, because they're going to decrease anyway. So a really great example of that is ATMs, where this is a computer and a case and a screen, and we know it's going to zero. That's what computer equipment does. So whether that happens more quickly or not, I could care less. What I care about is the predictability of the transactions at the ATM machine generating my cash flow. And so I've been looking at opportunities like that where I don't have to worry about a asset price decrease. If I think it's going to do well enough during a downturn and continue its cash flow, then that's been good too. So ATM is a really good example. I'm not this guy at all. I don't know where crypto is going and I don't speculate on it. but I did just invest in a Bitcoin mining fund that's actually meant to distribute cash flow. And I did it because another great downside risk mitigator is like, how do you get exposure to Bitcoin if you're a low risk guy like me, even if you think that it might go down? Well, the Bitcoin mining fund I invested in has a break even, like a cost per coin of about $8,900. We're currently at 60,000 or 55,000. So even if Bitcoin goes in half, if I bought it, I would have lost half my money. Here, we're actually making money, right? And there's also depreciation benefits. So not something I discuss a lot because I don't consider it low risk. The payback projections projected to be about a year. So it's a very quick payback too. I mentioned earlier on that stuff I've been looking at as a quicker payback now to reduce risk in case there's a downturn or an adjustment in the markets. But that to me is more like how do I get exposure to that in case I'm wrong about crypto, right? And actually have some downside protection in case crypto goes down, still make money, unless it goes down to very, very low numbers. So, there's other stuff. I'm always looking at other things too. I mean, I have a handful of startups. Clearly, that's 1% of what I do. Always looking at those, but only with people I know really well that I just have to make a bet on, not random. And I've done a little bit of what's called debt validation, which is similar to debt consolidation, where again, it performs well. In fact, it even does better during downturns where people need that service more. Mm-hmm. So another great thing that does, by the way, in the past, something else that's done really well during downturns, that's real estate, is aside from lower, more affordable housing like mobile home parks that become more in demand even during a downturn when people have to downsize and reduce their spend, is student housing, right? So student apartments. I did a little bit of that in the last downturn in 08, 09, 010, and did extremely well during that downturn just because people go back to school when there's a recession because they can't get a job. They want to maybe, that's a great time to go back to school. With what's going on right now with remote learning, with how the student debt, that's a little less clear right now, but that is another thing to potentially look at for a downturn.
Got it. What was your biggest mistake in real estate investing so far? And I mean, what lesson did you learn from it?
Yeah, I would say that coming from the corporate world, when I first started, I was working at Disney headquarters. If I had to I was a middle level manager. I had to present to upper level management. It would be a polished presentation. I would double and triple check it, right? A lot was on the line each time I presented. And so what I did is I went in with these preconceived notions in 2002 that if the documents and the presentation I got about an opportunity wasn't really polished and professional, like up to high level standards, I probably would pass on it. And what I've learned over time is that I'd rather invest with the best operator with the best execution with the worst documents than the worst operator with the worst execution with the best documents, right? And so I learned to adjust to my preconceived notion about documents and how they look, and more to really just dig into the experience and the deal and everything else, because some of these sponsors have nicer packages than others, because frankly, a lot of them hate dealing with investors. We're a distraction to them. They want to go buy a property and operate it. That's what they like to do. The fact that they even have to get investors is an annoyance to them, right? Because they'd rather just buy it and do it, right? So we're just a piece of the puzzle they need, but would rather, that's not what they want to focus on. And so that's one thing I definitely adjusted over time that I thought was very important.
Very cool. I wanted to just, for as long as you've been investing, can I ask you what was your worst investment? I'm just curious to see if you lost money, if you lost money or what it was like.
Yeah, sure. So, I'll share a couple of stories. So first of all, when I was investing in startups, back in the 2000s, I was younger, I would find this really great idea. Like, this is a great idea. I got to invest in it. It's going to be really good. But I didn't know the people very well. And then it went to zero. And I've had a few of those that it went to zero, right? And what I learned, which is exactly the same thing I've been applying to my real estate investing since day one, ironically, is that it's all who you're making a bet on, right? Which is kind of what the last point I made as well. Yeah. And so I apply that to my startup investing right now. And as soon as I switched that about 10 years ago, it changed the success of my startups even 180 degrees. So that was a huge learning. And several of my initial startup investments went right to zero. So that's the worst you can do, right? No cash flow, go to zero. I was in some accounts receivable financing back in 2008 and 9 when we had the downturn. And that lost about, I think it was 20 or 30% based off the fact that company just could not get past that. But again, that's not real estate and that's not low risk, but that's probably one of my worst performances as well. What else? I had a couple of housing flip funds break even around the 2013 to 15 mark because we had a partner dispute. There were 3 partners, 2 of which I knew really well that I wanted to make a bet on, one of which is the back office guy I didn't really know very well. They had a dispute, and the 2 guys who were really important for the execution left. And then we were left with this guy who I didn't know, who didn't really know what he was doing in executing flips. And so I came in and actually helped to negotiate him leaving in exchange for giving us the assets. And I brought in a more professional operator, and then we ended up breaking even because he had mismanaged some of it. So a break even doesn't sound so bad, but when you've got money out for 5 years and you're getting the same money back and you've got inflation, it's not a great result for an investor, right? So that's another example. I mean, I don't know how much time we have, but I've been in one foreclosure my entire 20 years, and it was a fascinating story. And actually, I didn't lose any money off of it, which is crazy. So, but that was actually a student housing apartment that I was in, a 300-unit apartment building, 303 units in Michigan. And it was just, I tell everybody that because I focus on the lower risk spectrum, picture me making a bet on a brand new airplane with the latest technology with redundancy and all these redundant systems where like you don't crash because one domino falls, right? One engine goes out, there's another engine. You don't crash because one computer goes down. It's got to be like 4 dominoes in a row that fall until you're really crashing, right? And thankfully for that, right? But if you invest in the old airplane that's 40 years old, well, one domino can fall and you're done, right? That's just the reality. And so I have an advantage that because of the risk profile I'm investing in, like if you're going into 100% occupied building with a diversified tenant base with a great sponsor, 4 dominoes have to fall. It's not one typically, right? So this was a case where like 5 dominoes fell in a row perfectly in order for it to get to foreclosure. I don't know if you want me to go through, but it's going to take a minute.
Yeah, go ahead. I would love to. I'd love to hear it.
Sure. So I invested in a student housing 303-unit apartment building in January of 2008 under the thesis that there was going to be a downturn and that it was a counter-cyclical downturn, exactly what I mentioned, where people go back to school. And it worked out perfectly. It was like 100% occupied when we bought it. It was 100% occupied every year, okay? Except in 2012. So part of the reason why the deal was unusually good is because we assumed a loan and it was coming up in 4 years. And we got favorable pricing as a result of it, okay? So this is like a very experienced student housing sponsor. They own 17 other properties and they really knew what they were doing. So long story short is that they managed everything really well, 100% occupied, pretty plus or minus. But it was the first property across from a state university, and there was a bridge that people had to walk over to actually get to the property or drive over, okay? So January of 2012 or February, the city sends a letter to all of the individual tenants and to the owners saying, we have to close the bridge for construction during the summer months because it has to be repaved or whatever it was. But don't worry, it's going to be open in time for the school season for the fall, right? So what happened? We go from 100% occupied to about 60 or 65% occupied because the students are nervous the bridge won't be open in time for them to go to school, okay? So that was domino number 1, right? Domino number 2, we had the loan due of all the years that fall, okay? That was a very bad coincidence and very bad luck, right? Domino number 3, at that timing, there was still some carnage from the 08, 09 downturn. This particular bank wasn't willing to extend the loan for a year because we were going to go back to 100% occupied once the bridge was open the year after and everything was fine. And we would have been about a break even, okay? Like we were too low as far as the debt coverage ratio, but we were about break even on the property. So for whatever reason, the bank would not extend the loan for a year. I think they wanted the property, which is very unusual too, because I think they saw the opportunity to get the property. So that was domino number 3, right? So we couldn't negotiate that. So foreclosure happened. And the amazing thing, and this goes back to who you're making a bet on, is that the sponsors I had made a bet on own most of their properties themselves without actually other investors, and they were very wealthy. And so when we got foreclosed, they had a partial recourse loan that they lost a lot of money on. They actually came to investors unsolicited and said, look, we feel really bad. We're going to transfer your equity from this property to another property we own ourselves, which is the first property across from the State University campus in Texas. So the transition took a year. Where it was no cash flow. There was all this legal stuff they're working through. And then a year later, I started to get cash flow again from the new property. And I'm still in that property today, right? So the only foreclosure I've ever been in was this like multiple domino thing, which makes sense because that's what's required to happen for like, and by the way, in any deal, I can tell you 20 ways it can go. Like there's all these 1% risks, I call them, right? You can have a fire, insurance doesn't pay. You have to sue them for 5 years. You have to cash call for that. And then during that time, you get foreclosed. Right? So I could tell you like, all ways, 1% risks that happen. And this was like what I would call a 1% risk because you can never go to 0% risk, right? But it was a great lesson in many ways, but I'm very lucky who I made a bet on that I'm still cash flowing and wasn't a loss, a loss for me at that point.
Got it. Like going back to the importance of just really knowing and trusting that sponsor, like what's your vetting process? I mean, I know that you probably go back to the same sponsors and operators and all that stuff, but like, do you have a specific vetting process for them?
Well, what I would say up front is that first thing I'll say is that I'm not going to make a bet on someone brand new. And I'm just going to be totally honest with this, and it's not going to sound good, but like, I don't want people to learn off my money, right? I want people can learn off other people's money aside from mine. And then, and I'm sorry if that sounds bad, just being honest. And my comfort level for whatever reason is like, someone's done 5 to 7 deals, preferably 7 deals. I'll start to seriously consider investing with them. But what I'll do if I meet them too early is I'll say, look, I like what you're targeting. I like your previous experience or your personality or whatever it is. Put me on your distribution list. I'm going to watch what you're doing. And I'm going to continue to watch what's going on. So I'll actually monitor them and watch what they're doing and see how they're structuring deals, et cetera. When I actually do the due diligence on them, it's going to involve a ton of questions about the deal. I usually ask somewhere between 100 and 250 questions on a specific deal. And that's not an exaggeration because I have notes and everything, right? I will do one thing that is absolutely imperative, and it's a test for them, is I will ask each of the managing members for their name, date of birth, and home address, and for background checks. I don't hit their credit, but I do a regular background check. And I actually don't really need their home address and date of birth typically, unless their name is like Steve Smith, but because there's a lot of those. But I ask them to test them to see if they'll give it to me if there's some type of hesitation. And then I always say to them, before I run this background check, is there anything I should know about anybody? Like, that you don't, that maybe there's a good explanation for, because I've had all kinds of stories. I've had one person say, you're going to see that I was stopped and they found a gun in my trunk and I was carrying my own gun. It was licensed, but I didn't realize I wasn't allowed to actually transport it from one location to another, right? So good explanation. Thank you for telling me up front, right? I've also, on the flip side, had people not tell me anything and find a bankruptcy from 10 years ago that they probably thought was wiped off of their background check because it's been more than 7 years and they didn't want to discuss it. Well, that person then, like, I'm not going to move forward with them because God knows what else they're hiding from me, right? So I always do a background check, and I do it in a specific test way, and that's a very important check. I always meet with someone in person at least once before I invest with them. Because you do all these other data points, but to me, it's a gut check. So the in-person thing is a very important gut check. Typically, I won't invest with them unless I'm doing at least one walkthrough of a property. And while I'm doing that walkthrough, I'll get a very good sense of how detailed they are. And I'm going to give you a really quick example. So I have 2 different types of property tours that I typically will experience. One is I'm going to fly to a hotel the night before, and they'll say, meet me at the property at 11 o'clock. Here's the address, and we'll check out the property. Great. I'll meet them at the property at 11. They'll walk me around the property for an hour, give me a high level view of what it is, and we'll go do our thing. I'll go back home. But the other type of person will say, I'm going to pick you up from your hotel at 10 o'clock. I'm going to drive you to the property. We'll have lunch after, and then I'll take you back to your hotel. So what happens there is that often that person will, on the way, say to me, like, let's say it's a retail strip center, just to make it really visual easy. And we're on the main strip. They'll say, well, here's our first competitor. They'll stop in, show it to me and say, I don't think it's a direct competitor because this tenant has been there this long. This is not a competitive tenant. This one is. And they'll show me the entire landscape. And then they'll maybe even drive me into like the background of the housing and say, this is where demand's coming from for the center. There's this pre-planned community and there's 6,000, residents here. And this is why the strip's probably going to be in strong demand for a long time, right? And they'll be so detailed with me, along with maybe at lunch discussing the property in much more detail than just a walkthrough, that you'll finish that meeting and say, wow, this is a really detailed person. It's probably going to translate into everything they're doing. That's interesting and a really good data point, right? So just meeting in person alone tells you a lot when you're reading between the lines, let alone what you find at the actual property and the quality of the property and everything else. So my job is to read between the lines. And a lot of the questions that I ask are not even that I care about the answer, but it's more about how they answered. It tells me a lot, right? So if I want to see if someone's conservative, because ultimately in the end of the day, I'm trying to find someone who's conservative, using conservative assumptions, under promising to hopefully be able to over deliver and build long-term relations with investors. I'm trying to avoid someone who's over promising, using aggressive assumptions to make the numbers look good and attractive, and potentially not really care if the investors reinvest with them because they're going to go on to other investors and keep marketing. And so one of the ways you can do that and sort that out, besides looking at their numbers, is, I'll just give you a really easy example. Let's say that the occupancy at your apartment building is currently 97%, and they're assuming an 8% vacancy rate every year. And you say to them, why are you assuming an 8% vacancy rate? The current occupancy is 97. Why isn't it 96 or 95? It's been 97% for the past 5 years. And they'll say, well, we might like to be really conservative, so we just want to make sure that we're using conservative number. We might overperform, but that's what we think makes sense. That tells you one thing, right? Then you got the person who, and I've seen this before, is currently at 95% occupied, and they're assuming a 4% vacancy rate. And you say to them, why are you using a 4% vacancy rate when it's 5% vacancy at the moment? And they'll say, well, this is in Austin, and we're right near the train, and it's a hugely growing area, and we just got 10% rent increases last year. This is going to keep going on. The building's going to fill up because the last 5% wasn't managed well, and there's going to be very strong demand going forward, right? And that's actually what I'm trying to avoid, because that's not conservative. It might be right in the end, but it's not conservative. So there's a lot of reading between the lines that I have to do to assess someone during due diligence. And of course, you're going to make sure they were thorough. They really ran comps properly. They ran a lot of comps. The comps made sense. You're just doing all these different checks on them that adds up to a gut check in the end of the day.
Yep. No, I love how thorough you are, and I love how you're just being honest about, making sure that they have the experience before you even consider investing with them. So thank you for that.
Yeah.
Just switching topics to, well, you touched about it a little bit earlier on, but I wanted to discuss it a little bit more in depth. I want to talk about diversification, because in real estate, we hear more about diversification. I don't hear it talked about as much so in like diversifying your real estate portfolio. Can you talk about the importance of, passive cash flow investors diversifying their portfolios, and how do you do it?
Well, where it starts off for me is which asset classes make sense or don't make sense for me to begin with at this time, right? So I've actually already outlined today that I won't look at office and retail because of the lack of predictability of where things are going, right? I won't look at hotels because of the average daily rate changing every day. I won't look at a single tenant, triple net single tenant property for industrial, even if it's just a Starbucks, for example, because I just don't want to have the single tenant exposure. So what I do is I carve out what I won't look at. And then you've got the rest of what you actually will look at, right? And then what you're going to do is try to get as diversified as possible across all those. The biggest challenge we have is that I have no idea. I can't say to myself, I'm going to invest in 4 self-storage properties and 3 mobile home parks and 2 apartments this year, because I have no idea what's going to come to me, right? It's not like I'm going on a shelf at Costco and buying 7 things. So diversification happens over time. It can't necessarily be perfect because you don't know what you're going to find. And I would argue that you're better off having imperfect diversification, but being much more picky on what you're investing in versus the other way around. Because I've actually seen people say, I want to invest in 3 apartment buildings and 2 mobile home parks this year. And that's their mission. But I would argue that that's not necessarily the optimal way to look at it, because then you might go into stuff that isn't quite meeting the criteria you want, just to you're kind of putting a round peg into a square hole, in my opinion. And so I look at diversification across asset classes, geographies, and operators. I think geography is very important, not just the obvious demographics trends, but it could be weather too, right? So there's certain asset classes I'll invest in Florida that I won't invest in others because of hurricanes. There's certain asset classes that I'll invest in for even in the north, mobile home parks have freezing pipes and stuff that are, so you have to really tailor what you're doing depending on the geography. And then you don't want to get too much exposure to one operator. That's very important, because there's 1% risks in all this. And one of the 1% risks is Ponzi scheme or mismanagement. And that's not something you can avoid in advance. You won't necessarily know in advance, but it's a fact of life, and you're going to have to diversify out of it. And so I hate to say this, but if somebody had all their money with Madoff, right, they may have lost all their money. But had they had to spread out across 4 or 5 different managers, they would have lost 20% of their money. And so I'm not saying it's their fault, but they could have taken a better diversification strategy, right? So I think that's very important. And asset classes is critical. And part of the reason why it's critical is because asset classes, different ones perform differently at different times in the economic cycle. And the pandemic is a fantastic, obvious example of this, right? Retail, there was a lot of carnage in retail and office during the pandemic, but there was a lot of demand at apartments and mobile home parks and other places in the right locations, right? So that's why that diversification is so critical if you're looking for more predictable cash flow, because it just helps to keep everything, at some type of flat range on average. And that's really the goal that I have, trying to live off the cash flow. So yeah, that's high level how I look at diversification.
You're in so many, syndications right now. I don't even know how you manage everything. Do you have a special system or what technologies or systems do you use even to manage it all?
Yeah, it's funny. Some investors I know have actually tried to create some systems and actual websites and stuff because to help people manage it. I am very My whole process is very straightforward. I have a spreadsheet. It's old school. Okay. It's Excel. And the day that I invest in a deal, what I do is I have a cash flow spreadsheet and it goes out 10 years. And if I invest in something, I'll find out when the first cash flow distribution is required or is projected to be distributed. I'll actually sort out based off an annualized number. I'll divide it by 4 for quarterly, and I'll literally pre-plug in the cash flow I'm supposed to be getting from it every quarter and when it's supposed to come. And then I can look at any column of any year, like any month, which is a column of any year, and see what's expected. And if something doesn't come, then I'll look into it, right? And also, if something is with plus or minus 20% of what is projected to be, because projections are only projections. I don't assume they're going to be accurate necessarily, like perfectly accurate. But if something's within 20 or 25% outside of the range of what it's supposed to be, then I'll actually look into it and see what is going on, either downside or upside. Because even upside, I want to understand like what's going on at the property. Why is it doing so well? And can that change the business plan? Meaning, will it sell more quickly or less quickly because of it, right? So I need to keep understanding. So I just track everything in a bunch of rows in Excel across a bunch of columns. It's really not fancy. Some people probably have better ways to do it than me.
Got it. I was expecting a different answer, but you keep it really simple and it seems to work.
It is simple.
Yeah.
I'm used to using Excel. And all I care about is the cash flow, right? It's funny because to me, when people look at the IRR or whatnot, most people look at the IRR of opportunity and then see how it performed. I'm all about the cash flow. So I focus number one on the cash flow. And then any upside at the end is just gravy to me because I'm dependent on the cash flow. So I have a little bit different approach than most people,
Some final questions for you. So like, what are you excited right now in your business?
So this is going to sound awful, but it's truth again, which is I've been waiting 5 years on the sidelines right now for the end of a cycle. And what I'm excited about is that if Powell continues to go down the path of actually reducing quantitative easing and then increasing interest rates next year, I'm finally going to see the end of a cycle and see if there are asset price resets that I've been waiting for, because that's made me go on pause, except for these other buckets and creative type of opportunities I've been investing in. I want to go back to the basics and invest in apartment buildings and self-storage and everything else that I love. Those are my favorites, but I can't do it right now. But I'm excited for 2022 and 2023 because I think it's going to bring the clarity that I've been waiting for. And I don't invest unless I have that clarity. So I think it's finally coming. We'll see.
Okay, cool. Any big goals that you're working on for next year, either personal or business?
No, I mean, the only thing personal is that we're considering leaving Los Angeles and moving down to a city called Irvine, which is in Orange County, which for those of you who don't know is about 45 minutes to an hour south of LA. So that's a definite personal focus for next year, sorting that out around the summertime. But investing wise, I'm just keeping a really close eye. Actually, the thing I'm watching closest right now from an investing perspective, I will be watching closely is that the yield curve. It's been flattening a little bit recently. It tends to predict a recession 6 to 24 months out based on historical data. It did the same. It inverted in 2019. And then we actually would have had a recession in March of 2020 without the pandemic probably. And it was a perfect predictor of the midpoint of when that would have been. And so I'm watching that very, very carefully, and I'll be watching that into 2022 as well as pricing. But that's it. I'm just monitoring things more than anything.
No, very cool. And so I like to ask this of all my guests as well. It's, what does success mean to you?
That is such a good question. God.
You could answer it any way you like.
Yeah. So, look, that the definition has changed for me over time. I used to, at the beginning when I started this, success was like, oh, I was able to leave the corporate world. That was phenomenal, right? And now I just take it for granted because it's been so long. Just to be totally opposite, it's fantastic being out of the corporate world, right? That was a very important milestone of success. Then I had a certain net worth that I was trying to hit, right? Which I've kind of gotten to. Everything I have is on paper, so it's hard to really value. You don't know what's really going to exit out, but if you take everything for face value, I'm kind of there. And so now I'm actually trying to figure out how I redefine it going forward. Is that a higher net worth? Is it a totally different shift of something for me? And I'm in the middle of trying to sort it out. So you're asking me a tough timing. And also a lot of success for me. My kids are 14 and 11, they're 2 boys. And I've been trying to spend as much time as possible with them, knowing that at some point, either I'm going to want to talk to me because they're teenagers. And that's already now happened with my 14-year-old, not that bad, but still. And so for me, success up until that point was knowing that I could be home and spend that time with them. I know it's like carved out as like scheduled an hour and a half, right? From 6 to 7:30. But knowing I was able to do that is really great because when I grew up, my father was never around. And so being able, I basically I've overcompensated and just tried to spend as much time with them on the weekend and do as much as I can with them. And another huge piece of success for me is at the very least, teaching my kids how all this works and teaching them to invest as early as possible, whatever format they want. I think that's given them a huge advantage. And I think I've been really successful at this point with that with my 14-year-old thus far. My 11-year-old hasn't really been open-minded to it yet, so we'll see what happens. Yeah, kids are all different, so.
Absolutely. What's your superpower? Like, what's your superpower that's contributed to this great life you have?
Yeah, well, I would say that, and you mentioned this, the first thing you talked about, which is I have a lot of patience and I have a long-term view. And I think that I have a lot of persistence and the ability to put my head down and just do what I need to do to get to a long-term goal. And I think that that's why I'm lucky enough to be on this podcast with you today, because I had a very slow and steady approach. I still have that today. I try not to get caught up with like quick profits. And as a result, I've been able to build a really nice cash flow snowball. And the reality is that the only reason why I'm sitting here today is because I have 20 years doing it, right? So if it was my second year, this wouldn't be a very interesting podcast, I think, and I wouldn't have as much to share. But the advantage I have is time, right? So anyone who's listening to this is brand new. The only difference between me and you is that I just had time on my side at this point because I've spent the time on it. But I also had a very long-term mindset and not the get-rich-quick mindset that I think is absolutely imperative that you mentioned right up front about all this. And so I think my superpower is the ability to kind of be able to trade off. There's a lot of people that have different sayings for it, but the concept of like, sacrifice today for tomorrow. I've had that mentality for decades now, and it's really paid off. And but I could say that now because I've had the time towards it. So
no, nice. And again, thanks for all of that. And I wanted to, if my audience wants to reach out to you, how can somebody get a hold of you?
Sure. Yeah. Everyone's welcome to reach out to me. I'm happy to help. If you're a brand new investor and just curious more about this, I'm happy to help. If you're experienced and want to network or whatnot, just for any reason, you can reach out to me. My email address is definitely the best way. So it's jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So it's jroll at rollinvestments.com.
All right, cool. Well, everybody, that's all the time that we have today. Thank you so much, Jeremy, for being with me on this episode. My conversation with you is very insightful, full of gold nuggets. Your firsthand experience in this space is amazing. I know a lot of people that are listening aspire to be passive real estate investors as well, and some people might not even think it can be done, but you're proof, Jeremy, that it can be done. For any of you that want to reach out to Jeremy directly for questions, I feel free to. I've connected with him a few times myself, even prior to this podcast, and he's been very, very helpful. So again, to all my listeners, thank you for checking out this episode of the School of Cashflow. And remember to leave me a podcast review on iTunes, as it helps me attract even more great guests just like Jeremy. So until then, live life abundantly.
Thanks for listening to another episode of the School of Cashflow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.